I think people are recognizing that whilst that move by the Fed stabilizes the credit market to some extent, and yes, we have had a 23% rise in US equities, we're still down 16%. And the scale of the economic shock is just starting to be felt in the real economy. So, we are talking about depression levels of unemployment. We are talking about earnings that are going to fall between 30 to 50% this year, Jeff. And normally, despite the comment from one of the companies earlier that this is going to be a one-year event, if you look back at 2008-9, it was 2 years. If you look back at 2000 to 2003, it was 2 years. It will be remarkable if this is just a one-year shock to earnings. We think it's going to be a 2-year shock to earnings, and that's the big adjustment, which is that earnings expectations for next year are up 27% for the S&P. That's not going to be a realistic number in our view. And that's the kind of adjustment that still needs to come through. The economic adjustment has not yet been made by these markets.
Ian, very good morning to you. I hear what you're saying, and I understand your skepticism, and I probably share it as well in many ways. But why can't these companies, A, grow into it over a longer term, grow into these valuations? B, you say maybe a 3 to 5 year event. Well, isn't that the timescale that most long fund managers are supposed to trade on as well? And my third point is the liquidity that's being pumped into the economy as well. A lot of it naturally will come into the markets by default rather than finding its way into the economy. Now, that's not what I want to see, but that potentially keep prices elevated in the stock market for longer.
I think the problem with that, Steve, is that, our starting point, PE multiples on the US market are 10% above their 10-year averages. So the idea that we're going to grow into this from an already overextended position seems very optimistic. And that liquidity, I'm afraid, is just going up to prop up the banks. Remember that the banks, US banks, are down 45% this year. That liquidity is required just to stabilize where we are at the current time. What we're not seeing in terms of our numbers, either in terms of the monetary stimulus or the fiscal stimulus, is enough to really drive things forward in an accelerating, rapid way, rather than just stabilizing things at the moment. And our concern is that until you see really strong signs that the dollar is coming down, that's a sign that we've got enough liquidity. That's a sign that we can really start to get excited. But at the moment, all that liquidity has done is just stabilize some of the demand for dollars that perhaps has been caused by the lack of liquidity going into the market, because oil prices have come down and still are very, very weak compared to historical levels.
Ian, a lot of people like you have been sitting at home, not sure what to spend their vast sums of money on when they're allowed to go out and spend again. What should our viewers be doing with their vast piles of money like you?
If only that was true. I was thinking about that list of billionaires. I'm afraid I'm definitely not one of them. We would still say, stay very defensive. We still think that there is at least one more leg down in this market. We think that will impact negatively on the economically sensitive stocks. So industrials relative to retail stocks, we still think they will come down. We still prefer things like the healthcare area over the financials. That always means that you want to be overweight growth versus value, overweight quality defensive stocks. So I'm afraid, Steve, I've still got the bunker mentality, and I'm sticking with my cup of tea and waiting this out.